That's Greg.
Hey, it's me. I'm here.
Okay, can you hear me all right?
Yes, I can hear you great. You have 5 attendees on right now. Me and you are the panelists, and Leia is on as well to pass her the host if you need to for her to do an intro.
Okay. All right. Share the screen. Okay. All right. And we got, how do I pass our control?
I think under the participants, I think you.
Oh yeah. Oh yeah. Got it. In the. Oh, let me promote her to panelist.
Yes.
All right.
Leia, can you hear us?
Leah, are you there?
I can.
Okay, so we promoted you to a panelist.
I feel very
You've been
special.
promoted. That's right. Yeah. All right. Okay. And then all right, is there anything else I need to do before I start, or just let Leah just go ahead and do the intro, or can the panelists hear us? Or can the attendees hear us?
I believe so.
Yes.
Okay. I don't need to. When I've done this on GoToMeeting, you got to do something to kick it off to bring them in. Okay. I think we're able. All right, so I am ready when you guys are. There we go. There's some chats. Okay, yeah. They can hear us?
Yep, let's
We're good.
maybe just a couple more minutes for people to dial on, and then I'll go ahead and introduce you, Greg.
Okay. At 11 participants now. As people submit Q&A, can one of you guys see that as well?
Yes, I can, Greg.
Yes.
Okay, yeah, so probably, so I don't lose train of thought, as they submit Q&A, kind of monitor those and then jump in and interrupt me if there's something I need to touch on. Otherwise, I'll just save them to the end.
Okay.
Okay. Well, let's go ahead and get started then. So hi, everyone, and thank you so much for joining the call today. It's my pleasure to introduce Greg Crabtree to you. Greg is a speaker, author, entrepreneur, and financial expert. The unique thing about Greg is that he built CPA firm Crabtree, Rowe, and Berger to be solely focused on the needs of entrepreneurs all over the country, helping them to build the economic engine of their businesses. Now, he has pioneered a revolutionary metric for driving business profitability, measuring labor efficiency, and developing simple benchmarks for company, team, and individual performance. In 2011, Greg published his first book, Simple Numbers, Straight Talk, Big Profits, which I have a copy of in my hands right now, and also totally changed my thinking about my company's financials and also changed the financial position of my company once I started to put these ideas into practice. So thank you so much for taking this opportunity to talk to us today, Greg, and it's my pleasure to welcome you to present these valuable secrets to profitability.
Great. I appreciate the opportunity. It's always fun to connect with some more entrepreneurs, to give them an idea of what I think my profession should have been doing the whole time. So, we'll kind of jump in. A couple of the ground rules. You can submit some questions, throughout the presentation. Mike Maxson from our team will kind of monitor those and jump in and interrupt me if it's something contextually I need to kind of cover at that moment. Otherwise, I'll kind of save the questions and answers, leave a little time at the end for that. So really, I mean, the first book was driven by this idea of I kept running into entrepreneurs and looking at the needs that they had. And really, once we realized that there was a need to kind of reframe how accountants work with entrepreneurs, I was working with an organization. I was a member of a group called the Entrepreneurs Organization, and I taught their accelerator program, what they called Money Day back then. And so it really was kind of born with looking at concepts to help start up to $1 million businesses, and I kept finding that the EO members who were in that class that had $5 million and above businesses had the same issues. So I knew that I had a really, touched on something that really affects all businesses, and as we've continued to adapt our philosophies, you're actually going to see a few slides. There's a little bit of a taste of the next book coming out here within the next couple of months. There'll be Simple Numbers 2.0 that really kind of reflects more of our current consulting framework that we work with clients. So I'll touch on a little bit of that towards the end of the presentation. So let's kind of jump in and get rolling, and so you guys can see. So really, in this original framework of what was missing is when I started getting interested in looking at our clients' data, I realized that I had to look at a couple of things differently. The first thing I had to do in terms of studying, entrepreneurs' clients' data was removing distortions. And if we were all sitting in a room together, there's 17 people on the call right now, if we took those 17 businesses, put their P&Ls on the table, all of you would have 17 different presentations of a P&L. And that doesn't help people understand data any better. And so what we created was a simple numbers framework to look at every business model in exactly the same way. Well, in doing that, I had to do a couple of things. I had to first look at owner compensation is the biggest distortive item that we typically find. And so I'll go through kind of a step of that here in a second. The other thing, there's some, if you have related party transactions with maybe you own a building and don't charge yourself a market rent, that can be another distorted. But really, owner comp was the first thing. But the second thing that was actually distortive was this idea of pass-through. So a lot of different types of businesses are likely on this call, and all of you are going to have different things that think of it in terms of the way we look at cost of goods sold. Those are items that are materials or other direct costs that are not labor, that essentially you're paying for it, passing it through to the customer. You may think that you mark it up. Whatever you mark up, anything that you pass through is really a reflection of the value of what that customer sees in your labor. And so we consider that a significant element to flush out of the system to get the gross margin. So the gross margin is the true top line of the business. And so we'll come back and I'll show you some examples of that later on, but I want to set that premise that we truly believe that revenue is vanity when it comes to P&L presentations. It really starts with the true economic top line of your business is gross margin. And that's really where the first dollar can be spent internally to drive your business success and profitability. Once we know gross margin, the next most critical element is direct labor. Whatever you define as the people who do the things that you do in your business, whether you make things or you sell things or you do things, that labor and just the gross wages, we like to take a simplistic approach of not burdening it with overhead. We don't burden it with payroll taxes. We actually want to look at clean labor numbers from a standpoint of going, what is that wage that person makes, and look at gross margin as an output measure to that labor. And so once we can draw those inferences and look at the movement and the increasing or decreasing of that, we can give our clients a better gauge of, is a dollar of labor producing more or is it producing less? That's really all you need to know. And if the market force puts pressure on you that it produces less by market forces, you've got to overcome that in some other way with either volume or other cost savings, or find a new disruptor to create greater leverage of that labor. And we can talk through some examples of that. And then ultimately, that being the key driver of profitability, the last piece is what we talk about in terms of the four forces of cash flow of, once you're profitable, what's the actual physics of business that says what are the primary sequence of use of profit in the correct sequence, but not in the sequence that most entrepreneurs apply it. And so the first key is, until I can get you profitable, cash flow doesn't matter. You're in a world of hurt. Once you get profitable, then I got to teach you a process of saying, here's the prioritization of the utilization of that profit, that meets the goals and objectives of the business and the owners and the stakeholders in the business. So we'll run through that. So the first thing, let's talk about removing distortion. So here's an example that I use a lot. 3 companies, $1 million of revenue. They've got salaries of different amounts, operating costs of roughly the same, but 3 different levels of profit. And so the first company, we're at a party together, and this person is saying, hey, business is great. I'm doing 25% profit. We're really killing it. Cash flow is kind of difficult, but the bank, they're always giving us grief about using our line of credit, and those bankers, they don't know anything, but we're really best in class in terms of profitability. And then company 2, that guy says, well, I think we're doing pretty good. But man, I got to go back and talk to my team about how do we get to 25% profit. If this guy can do it, anybody can. And so, but we're not having cash flow problems. We got plenty of cash, and I never talk to my bank because I don't have to borrow money. But we got to find a way to get up to 25% because that must be the industry standard. And then the third company is going, man, I tell you, we're profitable, but business is tough, and it's like the bank's always on my case, and I just don't know how I'm going to survive. But we're making it. Well, the reality is these 3 businesses are all exactly the same. The first business is faking 25% profit because the owner's not taking any wages, and they're taking out $250,000 in dividends, which is why they have a cash flow problem. The owner's taking all the profit out of the business. And they should have a $100,000 market-based wage for that owner. And so the real cash available to grow in that business is 0. Whereas company 2 is doing it exactly the correct way. They're taking a proper wage for the owner for the job that they're doing, and they've got $150,000 of free cash flow to either reinvest in the business or diversify their wealth and take it out of the business, depending on which is the best option. The third guy is, we call him Bubba down here in the South. He is the worst of all situations because he's taking an owner's salary above market of $200,000, and he's taking dividends as well for a negative $50,000 in cash flow. The reason why the bank's on his case is because he's established a $300,000 lifestyle on a business that really should only be paying him $100,000. And if you set your owner compensation based on the best year ever, you set yourself up for failure. Because I tell my clients all the time, your business should be able to always make you a market-based wage and pay you a salary for that job, assuming you're good at that job. And some of us are not always really good at that job, so we might need to find a different job. But if you're doing your job, the business should always be able to cover your market-based wage. The moment that you need to live off of the profits of your business to fund your consumption, you've set yourself on the road to a slippery slope to entrepreneurial hell. Because the business does not always have the capacity to produce a profit every year. It will, on average, do that. But when you set economic requirements of distribution of profits, when the profits aren't there, then you have to tap into business lending sources to be able to draw the money out, and then you damage the business further. And so from that standpoint, we have a philosophy of saying you get paid a salary for what you do. You get a return on what you own. And so don't confuse the two. They're two totally different things in that process. And so if you set yourself up to pay yourself a market-based wage, have the taxes withheld from that wage as if that's what you're going to live on, and live off of that net wage, then when the business makes a profit over and above that, you have a clear sight line to the tax implications of that, so you can set aside the tax money for that. And you then know the clear after-tax money that you have to be able to, should I reinvest in the business? And we'll talk about that decision later. Or do I take it out of the business and diversify my wealth elsewhere in that process? So let's talk about labor productivity. So I contributed a chapter to Vern Harness's book, Scaling Up. And in that book, in chapter 13, I use this example, and we call it kind of the baffle method of managing labor to basically taking the concept out of the NFL playbook of the salary cap concept. And so essentially here in the next 5 minutes, I'm going to teach all of you how to be profitability consultants. It's really pretty simple. So we find a business that's doing 4.4% profitability. And, and that's not acceptable because as a general rule, I want to see 10%. But there's some other reasons why it might be higher or might be lower. But in this case, let's assume 10% is the minimum acceptable profit level for this business structure. And so for them to get to 10%, the first thing I tell them is, well, instead of $320 a month in gross margin, I want you to find a way to produce $350, but you can't spend a dime more in labor. So that's the constraint. I'm expecting that direct costs excluding labor to vary based on a percentage, but I don't really care what revenue is. What I care about are dollars of gross margin. So this revenue number could be $550,000, as long as gross margin is $350. That's the key number that I'm looking for. And so you can see that step one is generally once you give someone a target of what the minimum acceptable production is, whether this is a year or a month, in this example, let's assume it's a month, that most of the times what I find is even people who feel like they have some constriction in sales, their challenge is they're not getting everything done and producing the revenue that they could produce with the clients that they in business that they have in hand today. And it's almost like when you fear that where the next sale is going to come from, you're almost afraid to get everything done and have people sitting around twiddling their thumbs. And I will tell you, that's the wrong thinking. You need to get everything done as fast as you can, even if you don't know what's coming next. Because when you save up work and then a new opportunity hits, you can't jump on the new opportunity because you still got to clean up the stuff and finish the stuff that you could have finished sooner had everybody worked with a sense of urgency. And so in this process, usually this is the first step, and it's the easiest one to get people to do because they now have a target. And one of my favorite sayings that we call Gregisms is, a man who aims at nothing hits it with amazing accuracy. So I'm making a very definitive statement of what good productivity means for our team. So once we get to this number, I'm saying, great, let's keep going. So I really want you to get to 15% profitability and still no change in labor costs. Now, let's pause for a second. I said no change in labor costs. Did I say that you couldn't change people? No. I mean, think of it like this. This is just like an NFL team. You have a salary cap of $90,000 of direct labor, $75,000 of management and admin labor, $35,000 of sales labor. I don't really care the mix between the three. You just can't spend a dime more. And I might be able to fire one person and hire two more if it's a highly compensated person. Maybe I let two underperformers go that are low-level people that I really just needed a higher-level person that I didn't even get to use, all of that. And so essentially that's the trade-off in that process. And so you don't really know if they change people or not, but in most cases, the first step you usually accomplish with the same people, getting from 10% to 15% sometimes is going to require probably changing a person or two and reallocating that labor base to different groups of people. But how you get there, the key is getting to 15%. Now, once you get to 15%, here's the baffle technique. I'm going to let you open up the salary cap and you sprinkle in some direct labor, you sprinkle in some additional management labor, you sprinkle in some sales labor, but only to the extent that it doesn't push you back below 10% profitability. And so now I'm spending money to push the business to a higher level, because what you're going to find is you can get to 10% profitability fairly easily. To get from 10 to 15, you may get there, but everybody's going to be beat up, bruised, bloody, arguing, dysfunctional, and you will expose every weakness in your business between 10 and 15% profitability. Every process failure, every personality defect is going to exhibit itself as you push to that level and stay there for any appreciable amount of time. So once you then take that labor and sprinkle it back in, you close the cap in, and then you grow back to 15% profitability. Now, a couple of things based on labor. Number one, labor is never measured by person. I don't care how many people, we have. What I care about is, how much did you spend in labor dollars? But there again, I think from that standpoint, you just have to look at it and say, do I, in terms of dollars of labor, get my thought here, in terms of dollars that I pay, that could be base wages, that could be incentives, that could be bonuses. And so $1 of labor is no respecter of persons, it's $1 of labor. Now, keep in mind, there's 3 different ways that you're going to pay money. It's either going to be you either give a raise, pay a bonus, or add a body. All 3 count, but 2 of those 3 are the gifts that keep giving. If I give a bonus, I've hedged my bet a little bit. And as we always try to consult with our clients about compensation planning, I really want people to understand that the error that we see the most is somebody giving a raise to someone for extraordinary performance that can't be sustained. And when a person that performs extraordinarily, they get a raise and they drop back to ordinary performance, then that's not good. You can't ever get back there. And so the key is I want everybody to understand, to discern the difference, and you got to make the call. And if you're not sure, use a bonus to say, hey, I recognize that. I just want to make sure that you're going to be able to keep doing that. So you might give them a little bit of a raise and a little bit of a bonus, but that bonus is intended to not commit myself to this level of unsustainable productivity that a person might have. And so just understand that. And obviously when you hire a person, that's a payment that keeps going, and you got to make sure that productivity continues. Now, where you use the labor efficiency calculation is, let's look down here at the bottom. So what we've done is we've established labor efficiency, gross margin per direct labor dollar, and now we get to establish some benchmarks. So in this particular company example, bad performance was at 350 of gross margin to direct labor. We got to 10% at 389. Guess what? Over here, when we got back to 10% again, it was in 3 cents of that number. We now know that 15% profitability requires a 422 labor efficiency ratio. When we get back to that labor efficiency out here, it's at 425. So it's very, very close, to that number. And so the way that you use labor efficiency, if you just take a snapshot, everybody always asks the question, well, what's a good number? Well, the good number is establishing, every business kind of has its own signature of what a good number is, in that process. So you do have to you do have to kind of keep an eye on that from the standpoint of, when are you running hot, in essence. So if in this case you might be a business that at 15% profitability you're going to be running hot and you can't sustain it. So therefore, that every time you start approaching a 420-something labor efficiency ratio, you better be out there recruiting the next capacity add, to your labor mix in that process. But once again, if I know that we're dropping below 389 labor efficiency, then you know that you're headed towards unacceptable levels of profitability, in that process. Okay? Sales labor efficiency ratio. Now, what you see here with these guys is they get up to an 829. Now, out here, when when we're ready for our next round to sprinkle in labor, I'm not adding any labor in my sales mix here because they're not back to their best ever labor efficiency. So they're at 738. And so now the salespeople, being salespeople, they will try to sell you on they should get raises too. And I go, great, I'll be happy to give you a raise as long as you get back to 829 in performance. And so once you get there, then you're going to be back, in the process to where, that's certainly acceptable. Management LER is a little bit slower move because management labor efficiency as well as sales labor efficiency is based off a contribution margin, not gross margin. And so once again, the salespeople we don't hold them accountable to revenue. We don't even hold them accountable to gross margin if we can. We really prefer to hold them accountable to contribution margin. And the reason for that is I want a salesperson to sell what we do best. And if a salesperson just sells to get revenue, they're not focused on gross margin, and they're not focused on what our labor is capable of doing in an efficient manner. Granted, they don't manage that labor, but hey, I got news for you. We didn't need to introduce the salespeople to the direct labor people, and they need each other. And my direct labor people need to love on the salespeople as much as the salespeople need to love on the direct labor people, because they're both tied at the hip. And really, this contribution margin line item is really the number that we believe is the critical number to focus on in every business model. Once you kind of have your operating expenses, they're just not going to move that much. And you can cut a little bit here, a little bit there, but, that's not the big moves. The big moves in a business to take it from unprofitable to profitable to thriving is increasing productivity. And that productivity measure is really just 3 input points: revenue, direct cost, and direct labor. And so that's why we base sales labor and management labor efficiency off of contribution margin. Management LER, though, as you can see, it doesn't move in as big as swings, but still, it's one of those that we've actually seen a fairly consistent number across all business models that once you're over $5 million in revenue, I would say there's a high likelihood that management labor efficiency should be in the 4.5 to 5 range. Not true for every business, but I would say 70–80% of them are going to be in that range. And so it's usually a good place to look. When we see a company that has lower than a 4 management labor efficiency, we're really looking hard to say either you've got some direct labor that's being misclassified as management, or you may be a little top heavy. And so, but like I said, we get to look at hundreds and hundreds of businesses models, so we've got a pretty good data set, for that. Okay, so let's go to the next slide. So these are a couple of things in terms of direct labor efficiency just to drive the calculation. It's gross margin per direct labor cost. That's just labor. Does not include payroll taxes and benefits. If you can also measure this by segment, this is a real power tool in business, to where if I can look at gross margin and direct labor by client or by project or by location, those are really powerful to really dig into and hold different segments of your business accountable, to each other. Management labor, same thing. Contribution margin is the numerator that we're holding it accountable to. And so the reason why we focus them on contribution margin is management has to drive revenue. They've got to control direct cost. They have to manage the salary cap. And so they have to make the decisions of when to add labor and when to cut. And they also need to be the primary leaders to make direct labor more productive. I would say the biggest fallacy that I see in business owners' mindsets today is they believe if I pay the person the right amount of pay, I don't need to motivate them. They're just going to do their job. And there's just no data that suggests that ever works. The reality is you're never going to get out of leadership and management. And one of the reasons why we help clients devise incentive plans and tracking plans and those things. But I'll be the first one to tell you, I'm more of a fan of, get somebody to produce and then adjust their pay to what they have produced, rather than trying to make their pay transactional. I've not seen anybody really smart enough to really create a pay system to make it work on, if you do this, I'll give you X. And that works. It may work for a while, but it won't work forever. And, you know, as margins start to compress with competition, the marketplace changes, you know, those are things that you just can't rely on to be permanent. But what you can rely on to be permanent is there's a market wage for every role, and there's an output expectation for every role. And if you can always align those things, you're going to be fine in that process. Sales labor, so one of the things I always get asked this question. So sales labor can be either direct labor or it can be management. It's a subset of management labor. So generally, if you have one or two salespeople on your team, I'm going to include sales as part of management labor, and then I'm going to do a separate calculation by itself of sales labor efficiency. If you're a business that your business is selling stuff, then your sales labor is direct labor, and your sales leadership labor is management labor. So we have clients that do hardware technology sales. So their direct labor are the salespeople, but their sales VP is management labor in that process. And so once again, we reiterate that, you know, it's not about revenue for these people. So you want to base sales incentives, if you have them, on contribution margin whenever possible. Second best to contribution margin would be gross margin, but never ever just on sales by itself. You know, and so there again, you're really trying to look at, you know, segment analysis by customer from a sales standpoint, and really find patterns of who's the perfect profile economically, you know, as a customer for your business. And sometimes your best profiles are not necessarily your biggest customers. Salespeople want to gravitate to the big home runs. A lot of times, hey, I can run a great business with a lot of singles and doubles. And there's a whole lot more singles and doubles to be had sometimes than home runs. So just kind of keep that in mind in terms of your sales strategy. So this is an example. So I want to give you a concept of now, how do we take this and put it in a practical case study situation? So a lot of times you're going to get in a situation where a business opportunity has come up and you need to add some labor or add a person. So this example, let's just assume that you've grown to the point and you're ready as an owner of a business to separate your role from being head of operations and sales to where you're going to head up sales and you're going to hire a COO to run the business. And so I'm going to show you kind of a model-up process to how to justify that. And so essentially we're going to use bottom-up targeting. So the first thing we're going to do is determine the amount of management labor dollars you're going to add to your model. And then we're going to set the management labor efficiency target to then determine contribution margin, which then tells us how much more direct labor we've got to add, and then how much gross margin that adding all that in, you know, makes happen. So here's essentially, you know, kind of how it works. So this business is doing $4.4 million in revenue. So the owner comes in and says, okay, I've got an offer to a COO, going to pay him $150,000. And so what we need to do is, you know, we really need to say, you know, how much contribution margin we're going to need to do, you know, to justify that. So the first step is we take this $150,000 times the 378 management labor efficiency. So 378 times 150, I'm sorry, let me back up. So the first step is 378 times 150 gets us to a contribution margin of $2,268,000. So that's management LER times management labor. Because we got to maintain then the same next direct labor efficiency number. So the next step is, so if I know this number of $2,268,000, well then I've got to add $300,000 of direct labor. So this is taking contribution margin of $2,268,000 divided by direct labor efficiency 289 minus 1. So this is the hardest math I'm going to ask you to do. So you have to solve within the parentheses first and then do the calculation outside of that. So it's really contribution margin divided by $1.89, which is 289 minus 1. So just accept that that's the formula. So once I know direct labor, once I know contribution margin, well, gross margin target now is pretty simple. It's going to be direct labor plus contribution margin. So now it's $3,468,000. Gross margin is staying at 59%, so I can back into revenue of $5,877,000. Now, I want you to stop for a moment and think, how much revenue did I think I was going to have to go get new for a $150,000 increase in management labor? None of you would have guessed $1.5 million roughly. So it's a 10 multiplier. And I've done this workup calculation hundreds of times with clients. And I would say the lowest is 6, and there's a few that are above 10, but it's between a 6 and a 10 90% of the time. And so use 8 as a good average. But just do the math. Do your math to that process, and you can definitively, identify. So if I'm going to add this COO at $150,000, I'm going to say, well, are you going, in the next 12 months, can you grow us from a $4.4 million business to a $5.9 million business, keeping all of our other ratios the same? And if you think they can and they think they can, then you got a green light decision. If they don't think that that's feasible, you're making a bigger long-term bet in that process, because this way you can actually, do the calculation, work your way up, and really come to a definitive number, that you can hold them accountable to. Certainly, I would like this within 12 months. I would say, without a doubt, I'd want to see this level of performance by 24 months tops outside. Otherwise, I would really question the sanity of the decision in that process. Okay? So next, let's talk about the 4 forces of cash flow. So in this process, the 4 forces of cash flow in the original book, I actually realized that I'd taken 2 things and kind of shoved it in one. So what I really want to do is I now kind of refer to as the 5 forces. The first thing I really want you to think about doing, so think of it like this. So this business right here is producing presently today $585,000 in net income. Taxes are going to take up some percentage of that. But essentially, if I spend the money, so if I'm doing this decision right here, look at what I'm having to spend first. I got to spend $150 here. I probably got to start ramping up some direct labor in anticipation of the new revenue. So I'm going to spend a good portion of this net income, before I start to see any benefit from it. And so in that process, the reason why I put make reinvestments into the business first is because generally those reinvestments are deductible. Now, I never, ever, ever want you to think that to spend $1 to save 30 cents and 40 cents in tax is a good idea. It's not. I want you to make a reinvestment in the business that will produce a 50% return on investment. So if I'm making a bet of $150,000, I need to at least see a 75% improvement in profitability minimum. Now, in this other example, we got a lot more than 75%, or more than 50% return. In this example, profitability by making a $150,000 investment, and depending on how much of this we had to advance higher, let's say even if we had to do all of it, you're looking at the original catalyst of 150 produced 232,000 in new net operating income. If I have to count both of these, that's 450,000. I'm still at better than 50% net operating income relative to if I had to hire all 300 in advance and this 150 in advance. If it produces this 232, then I'm within that 50% return standard for that process. So that's really the first decision that I've got to make, because as I said, when I have to spend money first, an investment in your business is most of the time going to be on your P&L, not on your balance sheet. It's not going to be buying a piece of equipment, although it could, but most of you are probably going to take Section 179, so it really becomes an expense anyway, and first-year expensing. So ultimately, that first decision is let's do this one first. So once I know what I'm going to reinvest back into the business, then I can appropriately calculate what my tax liability is to that moment in time. So the way I describe it is like this. When we're talking to our clients about taxes on April 15th, I'm not talking, so April 15th of 2019, I'm not having discussions with clients about 2018. We've already long since settled 2018 cash and technical requirements to file the return. What we're talking about on April 15th of 2019 is how much profit did you make in the first quarter of 2019, and how much of the cash that you generated in the first quarter of 2019 doesn't belong to you and either needs to be sent in or set aside depending on the tax payment rules for your particular business. And so that's the first thing I want you to know is how much of that cash in your hands is not yours. So once we set that aside, then that tells us if you have a line of credit, then how much free cash do we have to pay down against the line? Once I've paid down against the line and it's to zero, then I keep saving cash until I have 2 months of operating expenses in cash and with nothing, and which includes operating expenses and direct labor, and I want to have nothing drawn on a line of credit. Our definition of a fully capitalized business is one that you've got 2 months of cash and zero on the line of credit. Otherwise, you don't take any distributions other than tax coverage. So let's go back to this example. Now, these are annual numbers, but I would take the direct labor of $900,000. I take the OPEX of roughly $1 million. So what is that? That's $1.9 million. So take $1.9 million divided by 12. So what is that? So that's probably $300,000 would be their 1 month core capital, and then $600,000 of cash. So this is a business that should always have roughly $600,000 in cash. $900,000 and $1 million is, let's say you use $1.8 million to make the math simple, by 12, that's $150,000 a month. So 2 times that number is then $300,000. So they should have $150 in cash at all times, plus another month of or $150. I'm sorry, $150 is 2 months. So or I got confused there. $150 is 1 month, $300 is 2 months. Now, you don't include the $1.8 million up here in cost of goods sold because the presumption is I've got terms for my COGS. And so the main thing is from a cash perspective, I'm just using direct labor and OPEX in that process. So once you have that number and you've got, so in that business's case, as long as they had over $300,000, not including what they've set aside for taxes, then you get to do number 5. I now can pay a dividend. And so this goes back to my earlier comment of the reason why you don't set a standing demand of profitability to be distributed from the business is because I just don't know if we're going to have profit or cash flow that quarter. And so this is the really where we've had the biggest success of getting our clients to truly build wealth with their business, because they do it only after the business has produced the wealth and passed the safety zone of full capitalization in that process. So thinking through that capital, well, why do I need that money? Well, what we've done, and this is out of the new book that's coming out in a couple of months, is really what we've identified is you've got 4 needs for capital. In accounting school, they taught us this concept of working capital, so current assets minus current liabilities. Well, the problem is that's a flawed concept. So cash is part of the working capital, and so is short-term debt, lines of credit. So cash is a choice, debt is a choice. But what's not a choice is accounts receivable, inventory, accounts payable, and deferred revenue. Now, they are choices, in essence, from a strategy of what you demand from your customers and your vendors, but there is a range of what is accepted in your industry, and there's a range of what you're also capable of negotiating for your benefit, as well. But essentially, if I was creating an accounting methodology today, I wouldn't have accounts receivable and inventory on the asset side of the balance sheet and AP and deferred revenue on the liability side. I would actually net the 4 accounts together. And once I net them together, that's your trade capital signature of your business, which I'll show you some examples here in a moment of why each business is dramatically different in their industry and even within their own industry, depending on strategy, of the demands of how much of that you've got to fund yourself. Infrastructure capital is pretty straightforward. It's your fixed assets minus the debt that you've incurred to carry it. So as long as I attach the debt directly to that fixed asset, I'm okay with that, because I don't want to wreck my working capital by paying cash for fixed assets unless I just got idle cash and don't have anything else to do with it. Third piece is buffer capital, so that's your core capital target, the 2 months of OPEX that we talked about just recently. And then the fourth piece we'll talk about separately in a moment, called launch capital. So that was really where I was saying earlier about you have expenses hidden inside your P&L that are for future benefit. And to me, that's launch capital. And so you've got to find a way to isolate those expenditures and report on them in a way so that you know that here is the P&L from the static run of my normative business, and then here's what I'm diminishing profitability by for bets in the future of what I'm going to take it to next. So let's kind of go through an example of this. So essentially, I would say that there's only 3 business models that exist in business. You either make stuff, you sell stuff, or you do stuff. So that's it. Now, you might do a combo of those 3, but essentially every business fits in one of these 3 categories. So this making business, this is the one that we saw on the previous slide. So that was a manufacturing business. The selling business is the distributor. And so one of the interesting things that you can see here is the fact that in the distribution business, look at the profitability, compared 3.1% compared to 13% to sales for the manufacturer. The services business, even different, 10% profitability, compared to 13 and 3. Now, I've also added an item here as a percent to gross margin. And it's important to know that if, like in the selling business, because I have only a 13% gross margin in that business, remember what I said earlier, the true economic top line of your business is gross margin, not revenue. This business here that's the distribution business, they're under no delusion that they're a $40 million business. They're a $5.3 million inventory management business is what they are. And this manufacturer, they're not a $4.4 million manufacturer. They're a $2.6 million margin because they got to pass through these raw materials to make whatever they're making. But look at the services business. It's got a much smaller amount of revenue than the selling business, but look at how much gross margin it produces, but also look at how much labor it has to carry. And so therefore, services are great, stable businesses on the one hand, but as a percent of profit to gross margin, they're not so exciting. So generally what I do is when I'm giving this presentation, I always ask the audience, and I'm going to ask you guys, which business would you rather be? And it's a little bit of a trick question because I haven't given you all the information. So you can look at this and some people will say, oh, well, I want to be in the selling business because they have the highest percentage of profit to gross margin. That's fine, but really what we want to do is we want to look at it as a return on invested capital. So here's the net income from each one of those, but here is then the trade capital signatures. So you can see the manufacturing business, they have to carry receivables, they have to carry some inventory, but their vendors pretty much negate the inventory by giving them terms to carry the inventory only to the extent that they got terms to pay for it from their suppliers. And so their net trade capital is $542,000. So this one of the key signatures that we look at is trade capital as a percentage of 12 months of revenue. So trade capital is about 12.3%, which is below the profit percentage of this business. So what that tells me is this is a business that can grow pretty much cash flow free. They've got enough vendor support and they get paid fast enough from their customers and their profit level is high enough that for every dollar of new growth, they probably will feel that dollar. If this ever gets inverted and the trade capital percentage is above their profitability percentage, this is a business in trouble from a cash flow standpoint. You can see there are additional capital needs of infrastructure capital, fixed assets minus debt, and then their 2 months of core capital number. So this business's total required capital at full capitalization is about $1.1 million, and so that's a 53% return. The sales business would be 57%. The thing that makes the sales business work at 3% net income is because their vendors pretty much negate, for the most part, their receivables and inventory. If their vendors shrunk their support here, this business would go out of business because it's not enough profit percentage unless I'm getting trade support from my vendors. You can't support this with debt. You got to support it with either your own money or your vendor's money, or get paid faster from your customers. The services business, this is one that shows you a really interesting picture, 51% return, but this particular services business also is pretty good at billing in advance to get some money on deposit. If this deferred revenue number ever went away, then this business would really, their trade capital percentage would really shoot up, and they would not be very attractive from a cash flow standpoint. So this is really what all of you need to look at in your business to determine, is it healthy? So it's not simply, certainly I want to maximize profitability, but I also want to be mindful of my trade capital structure. I want to be mindful of what infrastructure capital I need, and I definitely want to be mindful of what my buffer capital requirements are at full capitalization. And even if you don't carry this amount of cash, I'm still going to calculate return on invested capital that way for you, because I really am going to lobby to have you carry those 2 months of net operating expenses in cash. Now, the last piece here before we wrap up is this other item of launch capital. So essentially, it's identifying an initial new spend. The primary typically is going to be either marketing or labor, occasionally some facilities cost. You're going to forecast how much your losses will be until the activity breaks even, and then the sum of those expenditures is going to represent your launch capital. And so there you have to establish an expectation of profit increase from that spend, and our minimum standard is a 50% return, preferably within 12 months. And this 50% return is in the increased profit, not increased revenue or margin. This is increase in net profit for that amount of the spend over that 12-month period. So this is an example of a client that took their business from $700,000 a year in 2012 to $10.6 million in 2017. So in 5 years, this business grew from $700,000 to $10 million. Each year, it was based on an intentional increase in marketing spend. So the first year, they increased it by $121,000, but they only got a 45% return on their profit increase was only $55,000, the 118 minus the 63. But the next year, they hit the jackpot. They got a 493% increase from that additional marketing spend. They thought they figured it out, so they increased it a bunch. As entrepreneurs always think, if a little bit's good, a lot must be better. So they bet the farm on it. Spent $394 in 2015, only to just get their money back barely and have no increase. But they retooled because theirs was mostly marketing spend, and so what they realized is some of the things that used to work didn't work as well, and some of their messaging needed to be changed. Some of their strategy needs to be changed. And so they tweaked all that, still committed to the spend, added more to it, then got back to a 91% return the next year, and then a 286% return in the final year. And so this is just one of the best examples I could come up with of any of our clients in terms of really choosing intentionally to not consume the profits of the business, but to make an additional bet, a smart bet. And as I said, it didn't work every year. But even with the 1 year it didn't work, they still grew from under $1 million to $10 million and were highly profitable every year along the way in that process. So with that, we got a few minutes here left. So anyway, well, let me do this one last slide. So ultimately the idea is, and in this slide, making sure you set aside your tax liabilities quarterly. Be focused on getting rid of that line of credit. Don't get drunk on always having a balance. Build your core capital reserves. This is, if you get steps 1, 2, and 3 right, it is amazing what happens to those businesses that we work with. I mean, having cash and having stability is just an amazingly powerful thing in the marketplace, especially when you hit a bump in the marketplace and all of a sudden you're the stable business and everybody else is struggling. So to us, I mean, that's really kind of the key. So with that, let me pause here and let's see, I think if I've got any questions.
I'm not seeing any questions that came through.
Okay. All right. So does anybody want to post a question for the group? Or Leia, do you have any thoughts that kind of hit you since you work with everybody?
Yeah, so my question, I just actually posted it too, is is that when we were talking before, I had said to you, every time I listen to this or read the book, there's more than I understand, but it's outside of my core competency. So what do you do? You know, the question for everyone else would be like, what do you do if everyone on the call, people on the call are saying, yes, there are so many things here that make sense, but where do I start? How do I implement this? And what happens if it's not my core competency? How can I still do this?
Right. Well, I mean, I think part of it is you take your data and start to report on it in this methodology. So, you know, I mean, certainly, I mean, we offer consulting services that will help accelerate that process. But I'll be the first one to tell you, I mean, I met a young entrepreneur in Reno, Nevada that he had read the book. If you go to simplenumbers.me, there's some free profit tools, spreadsheets that are free downloads on the site. And he had taken those things and he completely mimicked our model exactly. And I was just as proud of that as I am of our consultants who help people, you know, catalytically get over that faster. And this guy, I mean, he was a startup. He needed to save his money and do the best he can. So it is one of those things that I firmly believe that don't overcomplicate it. It really is as simple. We call it simple numbers for a reason, because what we're really trying to do is when you, let me go back and, when you take your P&L and put it in this structure, I mean, this is really kind of the key tool. And when you can report on it, when we build a model for clients, our model shows this structure monthly. We have a second sheet that then takes that monthly data and shows it rolling 3, and then a third sheet, which is the highest level of truth, is showing it on a rolling 12 basis. And so just that act alone gives people insight that they wouldn't have had. And then as you continue to progress, you know, you can then get further and further into your business depending on can you do segment analysis. Now, the next book will have more and more examples than the first book had, you know, that process. But I do believe that just the mere act of going through the exercise of this capital needs, I mean, take these 2 slides alone, put your numbers in this structure, and then calculate your return on capital. And you're going to be surprised of saying either you may be far better than you think, and otherwise you might be looking at it going, man, you know, how do I attack? Maybe I've got too much inventory. Maybe I'm not focused enough on receivables. Some of those things are just clean, actionable items of going, you know, one of the phrases we use quite often is we call it bill quickly, bill often. And so just the fact of billing quickly and billing more often will actually lower the days AR that you've got and being focused on that. Now, granted, it's like a garden. If you get a little sloppy, the weeds are going to come back. So you got to stay on top of it. But it gives you a framework to elevate the importance of every aspect of the business with your team. And certainly as you build your team then as well, in terms of as you delegate some of those responsibilities, at least everybody's got a framework and then of how to do it. But, you know, shameless plug, I mean, you know, Mike Maxon, our Director of Client Services, be happy to, you know, have a chat with anybody and say, here's how we do it and help clients get over it. And what we do for people, I mean, you know, we basically just grab your data, put it in our structure, and give it back to you in an analytical spreadsheet. And you get the whole spreadsheet. I mean, we're not hiding anything from you. Now, granted, we do this all the time. We're pretty fast at it. We're pretty cost effective at it. And so, but it's really, we're kind of agnostic from the standpoint of, hey, if you can do it yourself, then I'd be the first one to tell you, don't waste your money on us. But we don't have to look very far to find something to do every day either. So I'm not too worried about that aspect.
Okay, so Greg, let's say that even though you're trying to convince everyone on the call that they can certainly do this themselves, like I know for myself that there were things that I was definitely able to implement without help, because just having this knowledge and understanding more about how to implement it, there were very simple things like that definitely could implement, and it did change the way that I thought about a lot of things. But if anyone on the call is interested in engaging you because either they don't have the time or the resources or whatever, or need some additional guidance, how would they do that?
I think the best thing, Mike's the one that does all the intake and kind of run through. We have a very effective process that we start everything with a planning session. And that planning session can either be done on site, or you can come to us for a day, or we can do it over a remote session just like this and be screen share. And so each one, is priced effectively, to that delivery method, but we get to the same result in a sense that we take your data, put it in this format so you can see it better. And so one of the Q&As was, how do you get buy-in from your partners to do this? The fact that we can take your data with little to no effort of scrubbing it or fixing it, so to speak, the model, we've devised our techniques to where, as we say, we're really good with working with bad data. And so now you don't want to always work with bad data. You want to refine the system as you repeat it over and over and make it to where it's easier and easier to produce and it's natively existing as it should be. But the fact that we figured out a way to not cost you a fortune to then get that initial analysis, and it's pretty magical, to see what happens out of those sessions of people. We had one client that came to us doing $55 million of revenue, losing $2.5 million a year, and he walked out of the end of the day with a plan to make $750,000 in profit, drop his revenue back to $35 million, but. And it's worked. He went home and executed it, and that's actually exactly what's happening. Because we don't live in it every day, we're able to not get stuck in the weeds, to show him a path. Here's where you're making your money. Here's what's eating your lunch. Let's jettison that piece, and let's focus on this thing and build back from there. And they're well on their way of doing that. Okay, so I know that we're getting towards the top of the hour, but we have a couple of questions from some of the attendees. Sure. There's actually some in the questions. There's some really great feedback that I'll skip over right now on the call, because one of the questions is, let's say that I'm one that can figure out the early stuff on my own, pull Excel from the sites, get some early insights. What are some of the next insights owners often can't get on their own during some of the early work? Well, I think one of the things that you're going to get a sense of, if you take the spreadsheets that are available and do it on your own, you're going to get a sense of financial movement, because most of us get stuck into the calendar year thinking. So I'm a huge fan of rolling 12 data analysis. Every month ends a 12-month accounting period. And so the models are designed for you to force you to look at rolling 12 performance and look at really the bigger trend and ebbs and flows of your business, either positive or negative, and essentially establish some of those early benchmarks of what is good labor efficiency. I always tell people, they always ask me, what's your labor efficiency be? And I said, well, generally it's going to be in your own data. Somewhere in your own data is your best 12 months performance of labor efficiency. So go back and find that in your data set of how much data you plug into it, and then think back, what was happening at that moment in time, and how do I get back there? Once I get there, then I'm trying to break the 4-minute mile. So I use this as an example all the time of, it was widely believed that no human could run faster than a 4-minute mile until somebody did it. And the way that they did it is Roger Bannister broke the 4-minute mile by utilizing 2 people to pace him through the mile run. And so those pacers, really what labor efficiency is a pacing mechanism. it's telling you on a shorter term basis, say a rolling 3 versus a rolling 12, well, if rolling 12 is a good number, but the rolling 3 number is worse than the rolling 12, that's my pacing mechanism telling me that I'm starting to fall off pace. I got to get it back on pace quickly, or else I'm going to dig a hole that takes a lot longer to get out of. And so those are the concepts that you look at. You can also see the ebbs and flows of your capital items of AR and inventory, and do that net trade capital calculation, and look at return on invested capital, really looking back 12 months every month in that process. So those are the insights that you'll get. Now, granted, we have a lot of insights from examples and clients that we work with. So we've had people that did it on their own, but still came to us later for a planning session, and that we ended up continuing to work with, because they just realized that we could add more context to that data. So whichever way it works for anybody out there, we're happy to work with it. I think one of the questions I wanted to address was Chris had a question: how do you create a sales comp plan using sales LER? Well, one, I would tell you that when it comes to comp, I would challenge that thinking of all sales has to be variable. So Adam Grant and Dan Pink are two of my favorite business writers, and Dan Pink actually wrote an HBR article kind of questioning, why don't you use a fixed salary for your salespeople? And he makes a very valid argument, because we've actually seen some people do quite well with that. And so why is it that sales needs to be commission-based? Why is it that sales needs to be variable-based? I would push back and say it doesn't always have to be. Now, if it, from a market perspective, certainly you can use it, but here's really kind of the thing that we look at is we're more fans of taking variable compensation under a similar structure to the Great Game of Business. So if you read Jack Stack's Great Game of Business book, the methodologies that they use to calculate their incentive structure, if we're going to put one in, I'm going to lean to that process. So they pick a critical number and they establish ranges of performance, and you get a percentage of your base pay based on that performance. So if I'm going to base an incentive off of anything, it's a percentage of my base pay, not a percentage of revenue or something else like that. And I'm going to reset those parameters every year, because your business model is going to change every year. And I think that's anytime you give away a percentage of margin or a percentage of revenue, you've given away a critical stream of an annuity of your product line or service line. And I'm just not a fan of that concept.
Good. Krista asks a really good question, and that's how do you get buy-in from your partners or other decision makers that because you need some time to implement the system, analyze the current business, come up with a plan. So how do you have that conversation, especially if that conversation has to go into areas of compensation, whether it's other employees, sales, or owner compensation?
Yeah. Well, it's certainly a delicate balance, but if we can get everybody in the room, we're pretty successful in winning everybody over. And so that's generally one that I would say sometimes what will lead to, obviously it's more expensive for us to travel to the client site because of travel and time lost in travel, but at the end of the day, those are the kinds of meetings that are generally done in person on site, because you got to be looking at the person in the face, and you got to show them the compelling data, and you got to win the day and say, listen, but there again, we come at it from a fairly strong conceptual basis. Because one of the things that we have that we provide access to for all our clients is we subscribe to Economic Research Institute's Salary Assessor wage survey program. So we have access to a composite of all the publicly available wage surveys all across North America. And so we can actually pull a wage survey by role, by position, by SIC code, by location. And so by armed with that data, we know how to set market-based wages for every position from CEO to dog catcher. So that's not the problem. The client has to hold everybody accountable to the performance of once you set that market-based wage. Now, granted, if somebody's being paid over market wage, that's always a little more delicate of a discussion. But you just got to look at it and say, hey, you know, the business is not going to be able to afford that forever, no doubt. So, all right.
Yeah, so we're 6 minutes over, and I just wanted to say that I think we only lost one attendee in the last 6 minutes, which really indicates you provided an amazing amount of value, people staying on overtime just to hear all of your insights.
Great. Well, hopefully everybody found it useful.
And I wanted to remind everyone that in the chat, I did put a link to those simple numbers .me /profit-tools, where you can get the free tools, and then also simplenumbers.me services to get some more detailed information about the services that Greg and his firm provide, and also Mike's contact information if you wanted like a specific point of contact to reach out for some additional questions or some guidance. So you guys can copy that real fast and before we close up the call here. And thank you again, Greg, so much for your time and your insights and your knowledge.
Yeah, I appreciate it. Thanks for everybody attending.
Thank you.
All right.